Hi, I'm Tobias Carlisle. This is the Acquirers Podcast. My special guest today is Dan Rasmussen of Verdad Capital. He's got a new paper out called Counter-cyclical investing. We're going to talk about Dan's modification to Ray Dalio and Hedge's approach, and as a counterpoint to his crisis investing paper. This is going to talk about what you can do through the full cycle. It's a fascinating discussion. It's coming up right after this.
Tobias Carlisle is the founder and principal of Acquirers Funds. For regulatory reasons, he will not discuss any of the Acquirers Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquirers Funds or affiliates. For more information, visit acquirersfunds.com.
So you got a new paper out on counter-cyclical investing. What's the thesis?
Yeah, so this started from, I think if folks have been following Verdad or my research for a little while, it started with our idea around crisis investing. And we're small cap value investors, micro cap deep value investors. And we have obviously been plagued by the same thing everyone has been plagued with, which is small cap value not working for the last few years. And it led us to say, well, when does small cap value work? Or how do we know when it works better? How can we be confident, right? Because, you can say, well, small cap value is the best performing strategy over long periods of time. People say, well, not over the last 3 years. So you got to have
10.
Or 10. So you got to have some sort of thing that says, well, this is the reason it hasn't worked, and this is when it's going to start working again. And what we found, which was really cool, was that small cap value seemed to work really well in the beginning stages of an economic cycle. So if you started from the middle of a recession until the economy got going again, those periods accounted for about 70% of small cap value excess returns. So small cap value really is all about getting these crises right. You want to buy in at the bottom of a crisis and hold on in that early stage of the cycle. Well, okay, great. Well, how do you know you're at the bottom of a recession? The cool thing about that is that it's actually obvious. Okay, so it's like the one economic condition you know you're in, right? You know you're in the middle of a recession. Well, how? Your mom's calling you or your dad's calling you to ask them whether you should sell stock, right? Because it's about to be a Great Depression. When you get that call, you know you're in a crisis, right? You open up the Wall Street Journal, and if the front page headline is really big and says something about the market going down, you basically know you're there. Now, the indicator we like, which is a really beautiful, wonderful economic indicator, is the high yield spread, which measures the cost of borrowing for high yield borrowers minus the treasury rate on an option adjusted spread basis. And what we found is that, that's a really good recession indicator. In fact, Ben Bernanke did a huge amount of his academic work on it. So the Fed is watching this, academics are watching, the group at Harvard who's obsessed with it. I mean, it's a really wonderful indicator for all sorts of things, because it measures liquidity in the economy, right? How much are people lending? How much are they investing? And that's nice. It's contemporaneous. It's like right now what's going on with lending. And I think I have a very credit-oriented view of the economy. That credit is what drives the economy. And so when the credit markets are ripping, the economy is ripping. When credit markets are tightening, the economy is going through a tough period. So what we found is if you looked at just when spreads are above 600, you're basically in a recession, and that basically is a really good time to buy small cap value. It's also a really good time to buy virtually anything illiquid. So if you're in bonds, the lower quality bonds, in stocks, the smaller and the cheaper. And even if you look globally, like going and buying emerging market stocks as opposed to developed market stocks gets more interesting at times, and the high yield spread is wide. So all of these things are sort of related. And once we'd figured that out, and we've been executing on that thesis, and it's played out, perfectly during coronavirus, right? So if you went and, in March of last year, April, May, any time in that period and bought small cap value, and the cheaper and the smaller the value stocks were, the better you did over the next 12 months. It's been a massive, massive rally, and just, perfect example of how these types of factors work coming out of recessions. So then your question though is, well, what do I do when it's not a recession, right? And you add sort of two prevailing, two kind of governing concerns, right? One, I want to do something smart when we're not in a crisis, right? So I want to be choosing assets that are going to perform well in that environment. And overriding concern two is I want to have money to buy small cap value at the bottom. So I want to reduce drawdowns, right? I want to eliminate drawdowns, not eliminate, can't eliminate drawdowns. So I want to reduce drawdowns. So I have capital to deploy when others don't, and I can go buy small cap value. So, you can think about this, I have a variety of influences, but, one influence for thinking this way is Seth Klarman and Baupost, right? To simplify Baupost's model, and I'm sure he would hate to be described this way, but, think of a 7-year business cycle, right? Baupost is holding 30% cash, 40% cash for the first 5 years. So the S&P goes up and, Baupost goes up a little bit less. And then the market crashes and Baupost doesn't go down anywhere near as much. And then Seth Klarman goes and buys like a crazy amount of distressed securities and bargains. And then he just rips out in year 7. And over that 7-year business cycle, Baupost comes out way ahead, even though they lagged the market for 5 out of 7 years, right? They were just they're quite conservative in those good years, but that was what allowed them to capitalize on that opportunity. So you take that sort of idea or framework, right, of like be conservative in good times, you have cash to deploy. And then I marry that with sort of, Bridgewater, which is where I worked briefly when I was younger, of thinking, okay, well, can we do better than holding cash, right? Is there something you can do better than holding cash? There's got to be something that works, from sort of middle stages of the business cycle to the end, that's better than cash, right? And what might those be? And how could you incorporate other asset classes, whether that be treasuries, whether that could be real assets? And then I think the next sort of prevailing, the next big question I had, so with that as sort of a starting point, was to say, everybody's talking about inflation, right? And I think to have a true full cycle model, or to really think through investing over the full business cycle, you got to have an answer to inflation, right? What causes inflation? When's it going to happen? And what am I going to do about it if I detect it is coming? And so that was really the genesis of this paper, was to try to answer those questions, and to answer them as simply, thoughtfully, and empirically as possible.
Let me just take you back a little bit to the high yield spread. You say 6% or 600 basis points is sort of the trigger point for you. I've looked at that spread. I'm pretty familiar with it. It's very volatile over an extended period of time. When it spikes, often it does sort of spike very meaningfully. What's the significance of that point? And do you have any sense of how much time it spends above that? Above that point?
It's an arbitrary point, to be honest. It's a round number, but it's pretty close to 1 standard deviation above the mean. So you're talking, 15 to 20% of the time you're above 600 basis points. So it's a nice, it's an extreme market condition.
And is it impacted by the, we're in a regime with very low rates? Does that does the signal become less useful in this sort of regime? Have you looked at it over sort of more extended periods?
Well, I think one testament to that not changing is how well it worked during COVID, right? Like, it was a great indicator during COVID, right? It spiked up massively and then it came down just as the economy started to recover and the market actually anticipated the market recovery. And I think it remains the best indicator. And remember, it's a real market indicator, right? You're just saying, well, how are high yield bonds being priced relative to treasuries, right? And that, no one, it's pretty hard to manipulate that, right? Like, that's real lending activity, it's real investor dollars. And yes, the Fed could go and buy high yield bonds, and maybe they did a little bit of that. Really, they threatened to do it and they didn't do that much of it. But still, that's having a real impact, right? That's going to reset the prices of borrowing. And that has a real world economic impact, right? If borrowing is easy, fewer things go bankrupt and more projects get financed and there's more growth. And conversely, when, lending is really expensive or limited, things don't get funded. And that is, again, real world economic implications. It's called the financial accelerator. So I think that it is not diminished in its use as a signal. And I think the other signal, which we found was useful, is think of when high yield spreads are wide, that's the governing decision maker, right? Just go buy illiquid, risky assets. When spreads are wide, it's a really, really good trade. When spreads are narrow, that's a more complex set of decisions, and that's when you have to think more about real rates and where the yield curve is and some other economic variables, which are less predictive than the high yield spread. The high yield spread is wonderful. It's really powerful, and it predicts like a whole range of asset classes. Other economic variables are much weaker, and predictive signals are less weaker than the high yield spread.
So you had this crisis investing was some earlier work that you did, and you recommended when you get into that. When the high yield spreads are spiking, then you go to the things that are the most terrifying assets in the world, which would be a liquid small caps and high yield bonds. And so it makes perfect sense that those things would be completely abandoned and they would recover the fastest. But as you point out, you have this. It's an infrequent event, and you need something to do in the other time. So the new paper is this counter-cyclical look at asset allocation. And you're using these business cycle indicators, which I think are kind of interesting because they're widely available indicators. And the two that you like, again, it's the high yield spread, and then you're looking at the shape of the yield curve. Is that the 10 and 2, or are you looking at something more complex than that?
The 10 and 2, but it's interesting. So the slope of the yield curve, we easily could have substituted out just the short interest rate. That's really what drives the slope of the yield curve. Is all the volatility is driven by the short rate, and so that's what's really driving it. So you could just say, are rates high, are rates low, and that would be equivalent to saying, where's the yield curve?
Who's the gentleman who wrote his PhD thesis? And there's a Cam. I'm blanking on his last name. Do you know who I'm talking about? He did a little tour. He was on Meb Faber's podcast a little bit before the blow up, saying that he had seen the inversion and it was anticipating. So, it had been very predictive.
Yes. Yeah. So this is inversions are a special case, right? Where rates. So let's set those aside because it'll lead you to some wrong intuitions. But generally, I think the way to think about this is that let's just talk about nominal rates, right? Nominal Treasury rates are a proxy for nominal GDP growth. So there are two elements to it. There's the real rate, which is your GDP expectation, and then there's your inflation expectation, and those are both priced into Treasuries, right? So you can think of when spreads, when rates are really high, which would mean that short rates are really high, which would mean that the yield curve is flat. Your inflation expectations are high and your growth expectations are high. So those are times, again, when you'd expect to see inflationary pressures, inflation assets doing well. The inversion happens when rates react to that inflation expectation. Then they go too high, and that's when people think that there's sort of a tip over in the cycle. But mostly, you should think about high short rates or a flat yield curve as the market pricing bullish inflationary things. And conversely, when rates fall, the market is pricing either a collapse in inflation expectations or a collapse in real growth rates. And what makes Treasuries work really well in an asset allocation framework, or why they're really interesting, is that at least for the last 30 or 40 years, inflation expectations and GDP growth have been very correlated. So when there's a recession, expected inflation falls and GDP falls and Treasuries soar, right? That's why they're such a wonderful counter-cyclical asset class to own. And I think there's a lot of concern now with people saying, well, gee, owning Treasuries, are they really going to work as a hedge? Shouldn't I be selling all my bonds? Rates are so low. And I go back, this is Irving Fisher's idea, a brilliant economist. And Irving Fisher, right, has this idea that Treasuries are real rates plus inflation expectations. And so you have to ask yourself, which part of that is wrong, right? Let's say, is it that Treasuries are predicting too low GDP growth, or are they predicting too low inflation, right? And those are your two choices, right? And I think if you look at where markets are pricing things, the Treasury market is saying growth prospects don't look very good over the next few years, and inflation looks really dampened and maybe even deflationary over the next few years. And that's what's being priced into the Treasury market. So you have to come up with a thesis that's wrong. But certainly, I think if there's a recession, growth expectations and inflation expectations both are going to go down. So, I think there's still a very important role for Treasuries in a portfolio, and for using that as a signal, right? That's the market signal of growth and inflation, and it's a very powerful one.
Your countercyclical paper proposes an alternative to a 60-40 bond portfolio, though it's an asset allocation. And let's just discuss the. So you say based on the two elements that we've discussed, the high yield spread and the shape of the yield curve. Sorry, I've confused a little bit. The two things that you like are growth and inflation, and you then high growth, high inflation, low growth, low inflation, and some mix of those two things gets you these 4 quadrants.
Yep.
Do you want to just walk us through the 4 quadrants? And this is based on the Ray Dalio framework.
Yeah, sure. So this is a great simple framework for thinking about what asset classes do well in different environments, right? And so you can think about rising growth or falling growth, rising inflation, falling inflation. And all economic environments can be divided into those 4 quadrants. It's a really useful way of thinking because the combination of those economic factors, you get different each decade. You get a different set of cards, right? So in the 70s, you were getting a lot of low, falling growth, rising inflation, right? Stagflation environments, right? In the 2000s, you had 2 big recessions, right? So you had two big sort of falling growth, falling inflation periods. In this decade, right, you've had rising growth, falling inflation, right? So you get these different combinations, but those are the defining parameters. And so what you really want to understand is, well, what's going to do well in those environments, right? So if I'm thinking, gee, I don't think last decade is going to be, we're not always going to be in a rising growth, falling inflation environment, right? We could see a decade with multiple recessions. We could see a decade with stagflation. We could see all sorts of different combinations of economic conditions. And I should be prepared for all of them somehow. You'd want to start from saying, first, can I understand what does well in those environments? And then 2, I want to understand how to predict them or how to understand which environment I'm in. So I think, you can start off with the rising growth, which is rising growth. Think of this as the early stage of an economic recovery, right? We're in a classic rising growth environment right now and have been since March of last year, right? Where everything is looking good and getting better, right? So what asset classes do well in that environment? Well, the answer is relatively simple: stocks. Now, small cap stocks do the best, but large cap stocks, growth stocks, value stocks, it all does well in these types of environments. Conversely, bonds don't do as well, especially treasury bonds, right? As growth expectations and inflation expectations rise, so do yields, and so treasury bonds fall. And then, I'd say that as you get rising inflation, right? So we're in sort of this, people are calling it sort of a reflationary environment, right? Where you're recovering from a recessionary period. You also see certain commodities do well. So the economically linked, the growth linked commodities, your oil futures, your copper futures, et cetera. As that economic recovery continues, those asset classes all do really well. So when you're in a growth environment, which you can think of as, hey, start from the point where high yield spreads are at 600 bips and go forward, right? Those are the asset classes you want exposure to, right? You want to be as loaded up on small cap stocks, on value stocks, to the extent that you want real assets in your portfolio in the growth linked commodities, and you want to have a really light bond allocation. And if you're going to own bonds, bias them towards high yield bonds, which have a big growth component. So that's sort of that first environment, which is broadly the what Dalio or hedge I would call quad 1 and quad 2, right, which are the growth quads. And then you have 2 other economic environments, which is where things get tricky and more interesting and more complicated. So you have your stagflationary environment where you have rising inflation and falling growth, which is quadrant 3 in hedge and Bridgewater terminology. And that's an environment where a lot of things that people hold don't do well, right? So you have rising inflation, so that's going to hurt your bonds, and you have falling growth, and that's going to hurt your stocks. So you're sort of in a trap, right? Your traditional assets just aren't helping you all that much, and it's quite painful. So what do? And the answer is that it's all about real assets. So gold is especially good, but all of your sort of real assets. Now, your issue with energy and copper and some of the other growth linked funds is right. This is a falling growth environment. So, it depends, is the inflationary forces enough to overwhelm the falling growth? What type of inflation do you have? So gold is really good for a lot of different, environments like this. Other commodities are good. This is not something most people own in their portfolios, and there are a lot of reasons why you don't own them, which we can talk about. But those are really the only things that do really well in these environments. Almost every stock and bond portfolio, other than that, is going to suffer in this environment to varying degrees. And then you've got quadrant 4, which is your falling growth and falling inflation environment. And in that environment, it's all about bonds, especially treasury bonds, right? Treasury bonds are going to do really well, right? Because as growth falls and inflation falls, yields, real yields and inflation expectations fall. And so bond prices go way up, right? So you really want to own bonds in those environments, right? So you should think of, you've got your bond heavy environment, you've got your real asset heavy environment, and then you've got your stock heavy environment. And that stock heavy environment is, call it 50% of the time. And then you've got your other two environments where you're going to want to own real assets or bonds.
How often are you switching from one quadrant to another?
Yeah. So what we looked at is then this sort of a separate signal. It's like, okay, now that I know that, how do I sort of puzzle through what environment I'm in, right? How can I predict it, right? Because it's all well and good to say, wow, ex post, yes, obviously bonds do well in a recession, but if I can't predict recessions, well, who cares that bonds do well, right? Because I should just have a fixed allocation, or fine, real assets do well, but if we have a deflationary environment the last decade, I'm going to be pretty unhappy with the person that told me to own commodities to hedge against inflation, right? So in my view, you've got to have a way of predicting these things. So that's where we come to the high yield spread, right? High yield spread is really good, right? When the high yield spread is wide, you're generally in a growth, you're in a recession, right? And then the forecast is for a growth environment. And the direction, you can also look at the direction of the high yield spread. So as the high yield spread is tightening, right, that's generally very bullish. As it's widening, it's bearish. So you could both look at the absolute level and the direction, and that's going to give you a pretty good growth indicator. And then for inflation indicators, it gets really much harder, right? Inflation is hard to predict. There are different types of inflation. The only people who have lived through an inflationary period are people that grew up in emerging markets, right? There are not developed market, investors who have been investing since 1980 have experienced inflation. So it just gets a little bit more complex. You have to use a variety of indicators. A simple one is real rates. So, is the slope of the yield curve, or where short rates are, right? So higher short rates, a flat yield curve is going to be in a more inflationary environment. A very steep yield curve, which means low short rates, that tends to be a more deflationary environment. And then the other thing you can look at is you can look at the trend in the high yield spread, quite a good indicator as well. Or you can look at the trend in commodity prices, just another indicator.
What trend are you looking for in the high yield spread? Is it, how are you using that?
Tightening or widening, right? So as the high yield spread widens, that's deflationary, right? You're limiting the availability of credit in the economy, and as credit gets limited, inflation falls. And then conversely, as spreads tighten, which means you're increasing the amount of credit in circulation, that's generally inflationary. And that if you use that indicator to trade 10-year treasuries, it works amazingly. If you use it to trade commodities, it works amazingly. It's a really, really good indicator for thinking about inflation.
You also talk about trend. I don't know if it's in this context. So I think it was that you were using even the 200-day in relation to the S&P 500, but do you use it in other contexts as well?
Yeah.
How are you using it?
Yeah. So in that context, well, talking about inflation, right, and thinking about what drives inflation or how to predict inflation, trend is valuable, right? The trend in commodity prices, the trend in the high yield spread, it's a really good indicator for the direction of inflation expectations, right? So I think trend is really important there, and you can use that to trade some of these inflation-linked assets, right? Now, there are different nuances to it, but gold is a classic one, right? Gold is a very trending asset. When gold prices are going up, they're going up because inflation expectations or devaluation risk or redenomination risk fears are rising. And if you buy gold as they're going up, you do well. Conversely, when gold starts falling, it often keeps falling. It's a very trending asset. So trend following gold is a really useful way to think about whether you're using that as a way to think about when inflation is happening, or whether you're just using it because it's a good strategy that works in gold. It's an effective way of doing it. But we also talked about trend in another context, right? Which is we talked about one of the big goals of this counter-cyclical approach is to limit drawdowns, and to limit drawdowns with the intention of having a lot of money at a time of crisis to deploy into small cap value and high yield bonds and other risk assets. But to have the money, right, you can't have had a big drawdown. And that's what trend following the S&P 500, that's where we use it in this context, right? So trend following just says, when the price falls below the 200-day moving average, sell and go to treasuries, and wait to get back into the S&P 500 until the price of the S&P 500 is above its 200-day moving average. And the 200-day moving average is arbitrary. You could look at 3-month momentum, 6-month momentum, 12-month momentum. The moving average rule is basically just saying, let's pick an average of all the time horizons during this period. But the essence of it is that it kicks you out when volatility really spikes, and the and the S&P 500 starts in some sharp drop. Trend following kicks you out enough of the time to really save your bacon. So it's a dramatic reduction in drawdowns because you're getting kicked out after 15% or 20% drop, not getting kicked. You're just not there for the next 20% drop because your risk rules kicked you out. And the interesting thing about that, right? If you run a regression, this doesn't really show up that well in a regression, right? It's not a basically what it would tell you is you're gonna lose a little bit on your expected return. So my expectation about trend following and using trend following in this context is not that it's going to increase your return. It's not a return enhancement device. It's entirely about preventing drawdowns in large cap equities, and thus having money to deploy into crises, which if you're good at crisis investing and you think you've got high conviction in those environments is a very useful thing.
I've played around with trend following a little bit just to sort of understand how it works. And one of the observations that I had when I was doing it was that you'd get different results depending on how often you're consulting the signal. So if the signal is consulted once a month, then you run that sounds like a sort of a pretty good period, but you run the risk that the day before or the day of the signal being given, when you make that decision, you're not quite under the 200-day. So you're on, and then you catch that month of drop. And then at the bottom, this is really the only time that trend following, when I look back using that sort of look back a 1 month period using the 200, it might have been the 10 month. I can't remember. It's the same signal essentially. It works very well in the US, in other markets like Japan. Really the only time that didn't work, funnily enough, was 1987, which is when a lot of the trend following guys seem to have made their name. How do you recommend implementing that kind of idea?
Yeah, so it's not a fail safe, right? I mean, you can think of it as a dirty hedge or a low cost hedge, right? Is it perfectly effective? No. But does it cost you that much? No, right? And it's very low cost. In fact, over some periods, it enhances your long-term returns, right? But it at least seems like it's a almost zero cost hedge. But at the times when volatility is the highest, as long as that drawdown comes over a decent period, or if it comes in a day, trend following is going to help. If it comes over 5 days or a month, right, your trend, the longer the drawdown takes, the more likely trend is going to help you. And since most of the really big moves have taken a little bit of time, trend has really, really helped you. And again, I don't think you could do my view is you don't want to get too much into data mining, right? You want really simple ones. So, we tested 3-month, 6-month, 9-month, 12-month momentum, right? So is the price below where it was 3 months ago? Was it below 6 months? Was it below 9 months, 12 months? Right? You're getting virtually the same answer. The 200-day moving average is nice just because it blends all of them. It just says, hey, you're kind of looking at the whole past 12-month period and roughly where you are relative to the average. That's why I like it. But again, you could try to data mine it and say, the 3-month is so much better than the 6-month. this so much better than that. It's kind of BS, right? You're just looking, what's the point of what you're trying to do? You're trying to get out of this low conviction trade when volatility spikes, right? And that's it.
One place that it did work really well, and I know that this is a fund that you run, I looked at it in Japan because I always thought the challenge with Japan was that it was probably obvious in real time that the market was extremely expensive, in much the same way that everybody sort of knew in 2000 that there was a bubble in the States, and it was like 100 times in Japan. And I thought that the beauty of it was that it allowed you to stay invested through that entire run-up. And then as Japan sort of fell over in the late 1980s, it did sort of take you out. And the difference in returns is striking because the market fell so far and has taken so long to recover. Yeah. And it's sort of the return line goes up to the very peak and then plucks you out and then allows you to sort of remain above the fray until you get that opportunity to reinvest.
Yeah, this is such a good point, Toby. And I should have thought to go there earlier. But, if you think about the two big problems, I think, facing investors today, right? It's, overvalued equity markets, right? I think we're all looking at these multiples. We're all concerned, right? If you're not concerned, you're either not paying attention or half your portfolio is in Bitcoin and, whatever. And then I think, the other big concern is thinking about potential inflationary risk, right? And so I think you got to ask yourself, what am I doing to prepare? What is my strategy for dealing with these things? And the thing I love about trend following, right? And I did this piece about bubbles. And I actually went back and I had an intern look back at the macro commentary of like 10 great investors, Dalio, Peter Lynch, all these guys, Seth Klarman, right? And they all started calling a bubble in like 1995, right? So if you're smart, right, you see these things way early, right? You're like, oh God, value, Tesla's way too expensive, right? Or, the FANGs, oh my God, who would pay that multiple of sales? Adobe, MasterCard, Visa, right? You kind of go through the list, right? And you would have said these things were too expensive in 2018 or, 2019, right. 2017, right? And they've just kept going up, right? And the beauty of trend following, right, is that trend following says, you know what, just own the trend, right? Just own the NASDAQ, and what allows you to do that is, right, you're acknowledging explicitly that the reason you're owning it is because it's trending, right? The reason I own Visa or MasterCard is they've gone from trading at, 6 times sales to 9 times sales, and they might well go up to 12 times sales, right? Or that type of trade, right? And you're just saying, but if they start going from 12 to 11, I should probably get the hell out because this isn't a fundamental conviction thing. And I am worried about valuations. And trend following, whether you're talking about Japan in the 1980s, the NASDAQ in the 90s, I think it's just such a beautiful tool for exactly this moment in our market economy, right? And I think Toby, you and I, right, who are value-oriented investors, right? Value's at a dark winter. Now it seems like we're in the spring for value, but if you think about that period from Q1 of 18 through Q1 of 20, when value is just the worst possible thing to own,
rather not.
You would have said, well. All these guys that are owning the S&P 500 or the NASDAQ or things that look, or just a software focused fund, right, are just doing so well and I'm doing so badly. And, why not just own some of that, right? But explicitly say, you know what, I'm going to be the first to get out when it stops working. Because the only reason I'm owning it is because it is working, because I don't have conviction around these multiples. And how could you, right? It's just too expensive. But trend is a great way to rationally participate in the market while knowing that you've got protection in the event, or a plan to protect your portfolio in the event that cycle and that valuation cycle turns.
Let's talk about Japan a little bit, because you have a Japan value fund, and what's your approach there? What are you looking for, and how's the sort of portfolio constructed? How do you think about
Japan? Japan is a really fascinating market, right? It's a big market, so same number of listed tickers as the United States, but many more small and micro caps. So it's they're called 2,000 small and micro caps, right? So really big, deep market. It's also really cheap, right? So and you can look, whether you look at the large caps or the small caps, right? Like Activision, Blizzard trades at, 22 times EBITDA, and Nintendo trades at 8 times EBITDA, right? Virtually anything you look for has an alternative in Japan that trades at half the multiple. And so if you like small cap value at 6 or 7 times EBITDA in the United States, you're going to love it in Japan at 3 or 4 times EBITDA, right? It's just a brilliant market for value. And part of that's just that there's such a plentiful abundance of stocks, right, to choose from. Part of it is that they've had this, bubble in the 1980s, and then this, loss set of decades where the stock market has gone sideways. The other, 2 really interesting things to think about with regards to Japan. One is there's no bankruptcy, or essentially no bankruptcy. So, you think of the downside risk in owning smaller microcap value in the United States being, okay, you get a 0, you were just wrong, and the company blows up and you lose all your money. It doesn't happen in Japan, right? Companies live forever, right? The average age of a company on the market is like 50 years, right? They're just around forever. The government will bail you out. The government will really bail you out. Like in the US, we talk about bailouts, but the government doesn't actually that crappy industrial company that you own that goes through a troubled period. The government doesn't actually step in and give them a 0 interest rate loan to bail out their operations and go buy a competitor, right? Like that company goes bankrupt and goes through restructuring, and that's creative destruction. It's great for the U.S. economy at large, but it also is really screwy for your portfolio risk management as a small cap investor. And then the second thing about Japan is that it's an export. It's a cyclical export-driven economy, exporting into Asia, right? Big exports to the US, to Europe, to China, all over Asia. So it's really linked to the global macroeconomic cycle. When the cycle is ripping, these Japanese, net export companies are ripping as well. When the economy suffers, you get big, drawdowns. But again, because of the lack of bankruptcy, those drawdowns in earnings don't translate into drawdowns in the equity market that look anything like what you see in the US. And you also get this flight to safety impact with the yen, where the yen spikes in times of volatility. So you're really cushioned by the currency, which also provides this really nice ballast to the portfolio. So Japan, really cool, really interesting, diversifying place for value investors, and a big focus area for me.
I saw some research, it's a while ago now, it might be a decade old. I had it on the old Greenbacked website, but it was a study conducted in Japan just using simple price multiple, price to sales, price to earnings, those sort of metrics. And they had found that value worked really well through the entire period that, it's been a very long nuclear winter for that index. But underlying that index, there's been some great performance. If you're a value guy there, you've done fairly well. Has that research is probably 10 years old now, maybe even more than that. Is that still the case? Is that
it still holds, with the exception of like where everywhere else where value didn't work, right? This Q1 of 18 through Q1 of 20 period, where in Japan it was you had the trade wars with China, and then you had coronavirus. So, those hit real earning. I think Japanese corporate earnings were down 50% from 2018 to 2020. So,
that's a big hit.
Brutal drop, right? So yes, buying value, which tends to be cyclical companies that are, you're betting on mean reversion of earnings, right? Earnings didn't mean revert, they just went down. They just got punched twice in the face. And so, but now, now you say, well, gee, is coronavirus getting better? Yeah, probably, right? Are trade tensions with China going up or down? Probably down, right? Is the global economy rebounding, right? So could we expect to see Japanese corporate earnings rebound to 2018 levels? Yeah. What would that look like? A doubling of earnings, right? Would that be good for value stocks? Yeah, probably. So I think it's a very interesting time to be investing in Japan.
You sort of alluded to it earlier, but the criticism of Japan was that cross-shareholding and that inability to sort of release any of the capital or have any sort of rationalization of capital structures and businesses. But there seems to have been this, I haven't followed it that closely, but I've just read enough articles over the last maybe 5 years or so that perhaps that culture is changing. And I don't want to suggest that it's as a result of Americans like activists moving in there, but there might be some of that happening, that they've had to, I'm sure I've read a number of articles where they said they've had to modify their approach, but they are finding some success. Are you seeing that happening?
Yeah, I think that's definitely true, right? So there's definitely, look, Japanese CEOs want to make their stocks go up too. And, there's a method for making your stock goes up, which is to, follow these shareholder friendly practices, and they want to do it too, right? They're not idiots. So that is happening. Now you have to remember that that's still a second priority, right? So yes, it is a priority. Yes, they do care. Yes, they are moving in that direction. But the first priority is lifetime employment guarantees and stability, right? And so, yes, they'll move in this direction, but without sacrificing core Japanese values like lifetime employment guarantees, right? You're not going to see Japan wholesale adopt like U.S. incentive comp and have some, family-owned Japanese microcap paying their CEO $20 million a year. It's just not going to happen. Those aren't Japanese values. But on the margin, are they going to move towards, maybe having some independent board directors or maybe do an increase in the dividend? Yes, and those things are happening and they're good. But I think, even without those things, sorting by price to book multiple works really well, right? You don't need those things to happen. You just need value to work. And Japan has been a great, great market for value, and I think will continue to be.
Cliff Asness had some research where Japan had been one of the places where momentum didn't work. And so AQR looked at some of that research to say, I think that they decided ultimately that it was just, it's a statistical outlier. It's just, you would expect that if you have something that it's imperfect, but predictive, that that means it's not going to work everywhere. And I think that they decided that it was sort of a statistical anomaly. But is there any sort of concern that might, value might start working for that sort of reason, that it might be some sort of statistical outlier, or there might be some other reason that we just haven't yet uncovered for why momentum, for whatever reason, hasn't worked there?
Yeah, I have this is unlike many of my views, entirely unempirical and totally a stereotype based on my own experience. But I'll offer it with that full disclosure, which is that when we trading Japanese stocks, it seems to me that the U.S. is very anticipatory, right? So if you start to see some economic development, say, holy smokes, 2 quarters from now, that company is really going to benefit. The stock starts to go up, right? It goes up way in advance of the actual fundamentals. Whereas in Japan, it just seems like until you actually see the quarterly earnings statement where the earnings actually have gone up, the price doesn't move. And so I think if you think of momentum as a proxy for real earnings momentum, right, or change in analyst expectations, right, that sort of early updating of information before the actual news comes out, right, which I think what sort of how it works in the US. Well, imagine a market with no analyst coverage, really pessimistic, right? So if you look at surveys, Japanese investor surveys or Japanese CEO surveys, they're really pessimistic, right? So they're saying, so until you actually show them the numbers, they're not going to believe it. They're going to worry that something bad's going to happen. And I think to me, that's why momentum doesn't work. And to me, that's also why value works really well, right? It's that same set of things, right? Which is you're penalizing a company too long for something that happened in the past without taking into account the mean reverting or recovery potential that's embedded in the stock.
It makes perfect sense that it's been moribund for so long that you would require, you got to show me the earnings rather than sort of suggesting that they're going to happen. That it makes complete intuitive sense.
Whereas here in the US, if you say, well, I'm going to produce, half the world's cars in 10 years are going to be electric, and I'm going to have 100% market share of that, and my margins are going to be amazing. People are like, oh, great, well, that's such a good plan. Absolutely, let's underwrite that. Don't you think you could get 60% market share? But that's the US market.
Well, I guess the risk in the US is that it moves so quickly that you sort of feel the need to be in front of it. Otherwise, you miss the move because it's so closely scrutinized. Yes. And really the way that you've missed over the last decade is just by not paying enough, really, by not paying up, by not believing.
I know. It goes against every bone in my value. That's Sabati.
I mean, when you said that there was a lot of pessimism in Japan, that did excite me a little bit. It made me think that I should have a closer look.
Yeah, but as we were talking about, I think value investing is meta analytic, right? Value investors think, it's not about first order thinking. Do I like the stock or not? It's what consensus is embedded in the price, and how likely are events to come out ahead or behind that consensus. And value investors think, well, the higher consensus is, the more likely it is to be disappointed, right? And that's sort of our meta thinking. But as as we both talked about, that's not been the right. You haven't wanted to be a meta analyst. You just wanted to be a first order thinker, right? If you like the product, you like the company, just go buy it today in size, right? If you like the brand, right? Or if you come up with an idea like, I like payments, right? If you like payments, just like buy payment stocks as soon as possible, right? That's been the lesson. And all of the clever things that we've thought of, like, well, what about the expectations investing? And, what about fundamental earnings momentum? What about quality filters? None of that stuff has worked in the U.S. of late, with the exception of since now we're entering a new phase where we can start saying until Q1 of 20, we're in this blissful world where value is back. So hopefully now we'll get to start talking about why we're right all the time and how we've been right for years. We were just too early.
Well, I hope you're right. I don't trust it at all, but that's just
yeah. Well, you're a value investor. You're supposed to be somewhat pessimistic.
Dan, the paper is Counter-cyclical investing. Where can folks find it or track you down and follow along with what you're doing?
On our website, www.verdadcap.com. You can follow me on Twitter. We also do a weekly research email list, covers a whole range of investing topics. It's endlessly fascinating, I promise.
Yeah, I receive it. I can attest to that. I'm a big fan. Dan Rasmussen, Verdad Capital. Thank you very much.
Thanks so much, David.